What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benesocky and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. All right, welcome back to the show, everybody.
Yeah, welcome everyone. So we are in some turbulent times.
We are.
Turbulent times, and as we are recording this show, 11:30 a.m. PST on November 2nd, 2022, the Fed just increased the interest rates by 75 basis points. And BlackRock, one of the largest, money manager in the world's economists, were wrong. They believe it was going to be 50 basis points.
Okay.
So interesting times. It's a very hawkish approach. It's going to create turmoil in the equities markets. It's going to create turmoil in the real estate market. But looking at what's been happening with the equities market is just insane. How sensitive the stock market is. How sensitive is unbelievable. In real estate, something like this happens. Of course, it has a long-term effect. But just look at this. Apple, one of the greatest companies, down 15%. Tesla, down 75%. Amazon, down 41%. And it's just Google, 36%. It's just insane. So now imagine as a multifamily operator, and the market, goes through one of its cycles, because there's multiple cycles within the market, but now you're down 40%. Your investor is going to be at your house knocking on the door. So a great thing is about commercial real estate, that's not the case.
It's not as
it's not as volatile as the stock market. But so
that's why I always tell investors when they show up on investor calls and
Yes.
they're a little bit devastated because their portfolios in the stock market are down. I say, well, you got to diversify a little bit of your funds right into real estate.
Real estate and passive real estate.
And passive real estate.
Which you don't have to do any work on it, and it's not REITs. You're not paying those high fees. And
I always say backed by a tangible asset.
Absolutely. Now, it just happens to be, everything always works out in a certain way in our lives and here at CPI. And today we have a great mind when it comes to finances and debt and borrowing and lending and raising capital, all these topics within this environment. So it's like the perfect guest at the perfect time, and we're excited to be talking to our guest. And before we even got on the show, when we were saying our hellos and everything else, I was asking questions as he was getting into it. So
August is so exciting for this one, and we're going to ask his opinion about the rate increase and how that's going to look for the future.
Absolutely.
So let's go ahead and quickly introduce our guest so everybody knows who we're talking about here and why we're so excited. Today we have Edward Brown on our show. Now, for over 20 years, Edward Brown was CEO of a $40 million alternative lending company based in Marin County. Now, today he assists Pacific Private Money with capital raising and investor presentations. So Edward is also the host of 2 radio shows, and it is The Best of Investing with Mark Hanth. So we're really excited to dive into things and learn more about you, Edward. Welcome to our show. Thanks for being here today.
Well, thank you very much, August and Ava. How are you?
Great.
We're doing fantastic. Even better now.
All right. A lot of good stuff to cover.
A lot of great stuff to cover. You know what? We always love to start the show off, Edward. Maybe you could please go ahead and tell us about your background and your start in real estate, or more appropriately, your start in finance, please.
Gotcha. Okay. So I have a bachelor's degree in accounting and a master's degree in tax. And back when I started my company, when I was 23 years old, before getting into real estate, I also got my insurance license to sell life and disability insurance. And then also a little bit later on, got my real estate license. And during these times, I also became what they call a CFS, a certified fund specialist. So I was an expert in mutual funds and that sort of thing. And the reason was because I was doing a lot of financial consulting for clients. So I was preparing tax returns and then investing their IRAs, et cetera, et cetera. So that was my background. And then in the late 80s, early 90s, I came across a company that needed to sell some loans at a discount. and I negotiated a deal with them. And then I started to kind of get into the origination. I got my real estate license and started a company with my old partner that you had mentioned before. And we started originating notes, basically the hard money loan business. Back then, we were doing primarily commercial, no owner occupied back then. And then in 2013, I started working with Pacific Private Money, helping them start their first fund and raising money for them, being in investor relations. I had a lot of experience doing the investment side of it with the prospectus, et cetera. I was hired as an expert witness, and I'm still hired as an expert witness for various investments in real estate. And so I helped Mark Hanf with Pacific Private Money with his first fund, and his company has grown. Pacific Private Money has grown, I'd say honestly, exponentially. We now have 4 different funds, and we'll probably do volume close to $1 billion this year, very close if we don't surpass it. And it's kind of interesting because people they wonder how this all works. How do we pay such a high return to clients? Why do people borrow from us? Why don't they just go to the bank, et cetera? And I've written a lot of articles on this, but one thing I wanted to focus in on, and this is something that we had talked about before the show actually started, like banks and how they work and how they create money and the multiplier effect, et cetera. Basically, when someone goes to the bank and puts money in as a deposit, the bank gets to go to the federal government and borrow a lot more at a big ratio. And I can't remember if it's like 18-1 or 16-1 or, that sort of thing. So if someone deposits, $1 million in the bank gets to actually lend out $16 million if the ratio, let's say, is 16-1. That's how banks make so much money because they pay the depositors very little and they charge borrowers a fair amount, right? And they're borrowing the money from the Fed at really cheap rates. So that's they just make money hand over fist. The problem, though, is that especially after 2008 Great Recession, and I've been through a few of these kinds of things, where there's what they call the reverse multiplier effect. So let's say that you're the bank and you've got lots of great loans to easily fund. And then someone comes to you with a loan that says, well, I'm a great borrower, but my FICO score is, 3 points under what it needs to be for your bank. Well, if you're the banker and you lend money to this person, what happens when the auditor comes by and looks at your books and suddenly says, wait a minute, this loan that you made that has, a little bit lower FICO score than we're used to, we're going to make you put that on the watch list. Or if it goes bad, it goes into the default list, right? And what that does is the federal government then tells the bank they have to put reserves. You probably heard of bank reserves, right? And if you think about it, every time the bank has to put money in reserves, there's a 16-1 ratio of money that they can't lend out. So I wrote an article on this, why don't banks make conservative loans? Well, if there's anything outside that box, they have to be very, very careful because it can really come to bite them, from the standpoint of dragging out, let's say, $100,000 of money that they're not allowed to lend. They put that in reserves. Now they can't lend out $1.6 million because of 16-1 ratio. So that's why the banks are very, very careful, especially after the debacle in 2008, where now you have to have all kinds of ratios that debt service coverage ratio, et cetera, ability to repay, to make sure that you can actually pay those loans. Okay. So now imagine if you're a borrower and the bank says, gee, I'm sorry.
Right before you get into that, I think Ava's next question is perfect. Lines you up because she's going to tee you up for so you eloquently described about why banks are conservative and they could possibly get audited, and it's kind of the foundation for our next question coming up is alternative options people have when they get denied by banks. So go ahead.
That's right, Edward. I was gonna say let's discuss alternative debt lending. So we usually hear about bridge lenders, mezzanine lenders, private money lenders, and in Canada we hear of MICs, which are mortgage investment corporations. So can you break it all down for us and give us a crash
Okay,
course on private lending if you can, Edward?
okay, so there are lenders who specialize in commercial, which would be, multifamily, commercial buildings, shopping centers, et cetera. Then you're going to get ones who specialize in, like with us, this isn't the only kind of loan we do, but they're owner occupied consumer bridge loans. So somebody wants to buy a house. And again, let's kind of go back to what we were talking about where, if you're a borrower and the bank says no for these various reasons, what are you going to do? Go to friends and family, go to mom and dad, beg on the street. I mean, where are you going to get money, right? So there are alternative lenders out there who are still regulated, but they're not FDIC insured regulated with regard to reserve requirements and auditors coming in, et cetera. They still have to follow the law with not being predatory lenders and stuff like that. So like what we do is we specialize in the owner occupied consumer bridge loan, which is somebody who wants to buy a residence and live in it. There are a lot of lenders who will not lend like that. They'll only do the non-owner occupied or non-consumer loans. It has to be a business loan. And the reason is, and this is my belief, especially in California, we're just one of a handful of lenders licensed to do these owner-occupied consumer bridge loans. The reason I think is because it's a fairly expensive barrier of entry. You have to have the licensing, the continuing education, the legal, and the software. And that upfront cost could be 80 to 100,000 or more. So if you're a typical fix and flip lender, a commercial lender, et cetera, and you're busy because of the reasons why the banks aren't lending, why do you want to spend, especially if you're a small lender, why do you want to spend 80 to 100,000 entering a new space when you're already making enough money doing what you're doing, right? So again, we're not the only game in town, but we're one of the few licensed lenders to do this. So we spent the money, and we believe that we're one of the largest in the country now in the United States who do the owner-occupied consumer bridge loans. So, you got a situation where, and again, stop me whenever you want.
I was actually going to step in and ask a question. Like, who do you guys get your equity from? And then how do you guys set your rates?
Gotcha. Okay. So first, I'll answer the second question first about how we set our rates. It's all supply and demand. In California, there's so much money chasing deals that the rates are lower than if you're in Cleveland, Ohio. Okay. And it's primarily because most people believe that California is a more conservative market. Real estate doesn't go down that much, even when it does, and the upside is pretty strong. So it's considered a lot more of a conservative loan. So we set our rates basically by the supply and demand. Right now, and especially interest rates going up, we also, let me go back, in the old days of lending, private lenders were generally charging about prime plus 5%. That was typical in the old days. Alternative financing, we used to call it the best kept secret in investing. It's no longer a secret. And so what happens, more supply of money pushes the price down. So now the rates kind of came down to prime plus 3, and now they're even squeezed a little bit more because with the interest rates, especially now going up to 7, now the prime is going to be at 7%. Actually, I guess we are pretty close to prime plus 3. So rather than prime plus 5, we're close to prime plus 3, and generally we're going to be at fixed rate. We're not going to be a floating rate, but we do short term. So someone will come to us and we'll lend money out at, right now on a first mortgage, but somewhere between 9.5% to 10%. 11 months is our bridge loan product. If they need a little bit longer term, it's not a bridge loan, it will usually go out up to 2 years. So the other question is, where do we get our money? It's going to be from various investors, all right? And the investors right now, depending upon which fund, like we have a fund that is, I don't know, it's kind of like the granddaddy of them all. It's called our Freedom Fund. It pays, minimum investment's $250,000, and in all our funds, you have to be an accredited investor. So $250,000 gets you a 7% rate, 500,000 gets you 8%, and $1 million or more gets you 9%. Here's the best part. All of these funds that we have are these Reg D 506, et cetera, whatever the code is, right? And all these funds say that there's a 1-year lockup. However, we do not institute the penalty for early withdrawal on that Freedom Fund. So all we request is a 30-day notice. So, and you go, wait a minute, hold on, that's almost like a money market account. You can't write checks against it. But can you imagine you're trying to figure out, gee, the stock market's down, I want to maybe get back into it, or I want to buy an investment property someday. Where can you park idle money and get at least a 7% return in today's market with no volatility of your principal? I mean, that just doesn't, I mean, I've been in this business now, like in business for 40 years, and I've never seen this kind of conservative return, product with this high a return. Now, the magic question people will ask is, well, if you're doing 11-month bridge loans, how can you offer a 30-day redemption period? Well, on that fund, we're primarily packaging loans and selling them to big institutions. And we do that roughly every 2 to 3 weeks. So imagine one borrower wants $1 million, another borrower's 500,000, and et cetera, et cetera. We'll make these loans, we'll package them and sell, let's say, $5 million worth to a large institution. And in 2 to 3 weeks, they write us a check for $5 million. So then we take that 5 million, and the first question we ask is, has anybody requested their money back? If they have, write a check to them, cash them out. The rest of it, if let's say $1 million wants to be redeemed, okay, well, now we have $4 million to lend out.
Right.
So it's a very conservative product because we don't even own the loans after we fund them and sell them in 2 weeks.
Got it. And Edward, is it fair to say when I described, syndication and us here at CPI Capital and the services we provide for passive investors to be able to invest in commercial real estate and institutional commercial real estate passively, is it fair to say that the services you offer when it comes to your investors is an option to passively invest in the capital markets?
Oh, it's absolutely, it's absolutely passive. And we have other funds that will do more on the commercial side. And even this fund, there are some loans that we do and hold in this fund. We have 4 different funds.
Fair enough. But what I'm saying is somebody believes in commercial real estate. Let's say there's an investor, he's a physician, a lawyer, an accountant, and believes in commercial real estate, multifamily, in these large multifamily buildings, can't really afford or to manage these 100-unit building, comes and partners with us. Then you got another investor who believes in this concept of private lending, that everybody at some point needs to borrow some money. I've done it. CPI Capital has done it. A lot of people go through those options, and they believe in that type of investing, and then they can come and invest with you rather than going out there and actually private lending it themselves to vet the applicant, to vet the asset. You guys do all that work for them.
Correct. And so there's debt funds and then there's equity funds. So all of our funds right now are debt funds. And the beauty of it is the fact that you don't have to worry about tenants, toilets, repairs, that sort of thing. Whether or not people are going to be paying their rent. You're the bank. We are the bank, basically, okay, with all the documents that regular banks have. But the returns that we give our investors, 7% or more. I've owned a lot of real estate, and I've sold.
Is that net of fees? Is that net of fees?
Yeah, that's net of fees. Because remember, we're charging the borrower 9.5% plus a couple of points, and then we take up. We take our management fee, we pay the client 7%, and then the rest of it, pays the lights.
What's your default rate?
I'd say it's less than 1 to 2%. Because the thing is, some of our loans, actually, it's kind of funny. People think, well, if people are borrowing money at 9.5%, they must be risky loans. Well, not really. I mean, some of these loans are smoking hot, but the banks just can't fund them in time. I mean, we've had situations where somebody owned a house for $2 million, and it was an older couple, and they were on Social Security. They wanted to downsize because they didn't want a 2-story house anymore. And so they wanted just to be a one-story house. A house came on the block down the street from them that was 1-story house. So they obviously knew the neighborhood, and they the purchase price was $1.2 million. They wanted to get this house quickly because they knew it was priced pretty reasonably, and they knew the street. So they were, this was a perfect situation for them. Well, two reasons they used us. One, speed. So we could get this loan done very, very quickly for them. The second reason is that the bank wouldn't lend them the money because they had all this equity in their house, but their income wasn't high enough. So what they, and a lot of times the banks are going to be looking, how long have you lived, you worked at your job, et cetera, et cetera. So what we did was we actually lent them the entire $1.2 million to buy the house. They had to come up with the fees on their own, but for the points, but we lent them the entire $1.2 million, but we ended up being a first mortgage on that property and a first mortgage on their $2 million house. So if you think about it in total, our loan to value was, 36% or something like that. Maybe it was less than 40%.
What's the highest LTV you go to?
We have pushed it to 75% cumulative if we know the area really well and the property. Otherwise, we try to keep it below 70.
And then you're okay coming in at second?
We'll do seconds also. Generally, though, we're not going to do let's say $100,000 second behind $1 million first. We don't like that ratio. But
what is the ratio? What is the ratio?
I would say we've got to be, let's say if it's a $600,000 first, we could do a $400,000 second. But we, on a property like that, we'd want to see the property being worth, at least $1.6 million on something like that.
Yeah, no,
we're not interested in foreclosing people out and throwing them out of their houses. If we have to, we will. But
I've studied debt funds or mix for a long time, and I have a good understanding of them. And I always suggest, debt funds as part of a well-diversified portfolio if you believe in real estate in this concept. I mean, it's money lending. You hear about it in Shakespeare, and it's been around. Probably one of the oldest businesses out there is this concept of money lending. It does have a bad rep, but it also has a great rep, and it helps people it does.
I mean, we really try to work with our borrowers. And again, like I said, I've owned a lot of real estate, and I've actually sold real estate to do the debt funds because I like coupon clipping. I don't have to worry. It's really the borrower that has to really be concerned, because if the property is worth $1 million and I'm into this as a lender for 600,000, they have a lot to lose, and they're going to make sure that I get paid. So true, I don't participate in the upside of the property, but with the cap rates the way they are right now, I'd much rather just get a solid 7% interest rate rather than a 2% or not 2%. Let's say a 4.5% rate of return on my money, but hope that the property goes up in value. So I don't get the tax advantages of depreciation and all that, but I sleep at night very well knowing that I'm going to get a good interest rate. And if for some reason the borrower defaults, guess what? Now I'm going to own that $1 million property if I'm the high bidder at foreclosure sale, which has happened.
Yeah. And I like that you incentivize your investors to invest, a little bit more, and they get more of a return. It goes from 7 to 8 to 9. So that's
And the reason we're doing that is we've got at any point in time about $15 million in our pipeline of loans that we need to fund. And this fund right now is about 40 million, but it's constantly growing because we have lots of agents who now know about us, and we don't compete with them. We're just a short-term lender.
Great. Edward, quick question for you. If you have an investor, and we're going to get into investor relation topic in a moment here, but if you have an investor who you're looking to work with and they say, hey, inflation is at 8%, if I invest with you, I get 7%. So by the time next year comes around, I've actually lost a percentage. What would you say? It's the same problem that we have. We have in one of our tiers a 10% preferred returns in one of our classes of investments, and that's a question that gets asked from us as well about inflation. What is your response to that?
Well, again, we have 4 different funds. One of our funds does it's a construction loan fund that pays pretty close to 10%. But going back, let's say, why would anyone invest in this specific fund? I would say use it just as a holding tank until you find that investment that's going to beat inflation. Again, this is money that you can access with just giving us 30 days notice. And in fact, we've had people put a request in for redemption, and they hit it just at a time when we were going through a trade, they got their money back in 3 days.
Got it.
So, the question is, why do you have any money in in your checking account? Well, because you have expenses that you're going to have to pay, right? And yeah, you're not going to be, if inflation is, and I think it's actually, inflation is greater than 8%, what the Fed is saying. But again, I've always said this, everything is based on alternatives, right? The safest thing you can do with your money is put it in your hand because you know it's there. But you don't earn any interest on it, someone might steal it, et cetera, right? So now you start going up the ladder and you say, okay, well, then you should put your money in the bank. Well, but what am I getting in the bank? 1%? No. So again, you start kind of going up the ladder and say, how much risk am I willing to take for what reward? And on this specific, I know I'm pushing this specific fund, but again, I've been in this business a really long time, and I just don't know of any other loan fund out there, debt fund, that gives you this kind of liquidity for this high return.
No, it's tremendous.
You usually get one or the other.
It's tremendous, tremendous. Now, jumping back onto the educational side of things, you talked about prime. I'm familiar with prime here in Canada as well, but could you explain what prime is, and then also compare it to SOFR? What is SOFR? What is prime? How do?
SOFR?
Yes.
I'm not familiar with SOFR.
Oh no.
No.
It's secured overnight rate.
Oh, okay. I just don't know what that's that term. I'm sorry. I didn't know the acronym.
Yes.
SOFR. Okay, gotcha.
It's basically the benchmark that commercial lenders use to lend to us. So they say 5 over SOFR or what happens. That's kind of their floating rate is relative to the SOFR, where I believe on residential you guys go by relative to prime, right? Is that fair to?
Yeah, but there's also another one called COFI, cost of funds.
Yes.
So it may be similar to your SOFR. Yeah, yes. It may be similar to that. It's funny. Prime rate is just one of those rates that the banks just come up with, I believe, because they got to come up with they call it something, right?
Is it floating or is it set? So it's not like a Fed's fund. It's not like the Fed's rate where today went up 75 basis point and it's consistent until next.
Well, yeah, it is. That's how prime works. I mean, it'll be set and fixed until they change it again, right? I mean,
is it the same as the Fed's rate then, prime, or is it?
Fed's rate is different. It's a lot lower, and I believe the Fed's rate is rates that banks get from the federal government, which is different. Prime is going to be more for the consumer.
There's a spread on that because that's
exactly. And boy, I tell you, in the old days, I used to borrow money at prime minus 3/4. Can you believe that? Now you got to borrow at like prime plus 1.5 or prime plus 2. If you
don't bring up the old days. Everybody talks about the 1970s and 80s where it was at 20%. But we touched on that. So let's touch briefly on the fact that we're the world is about to explode. That the rates are now where they're at. I believe now is well over 7%. We'll see where they go at today. But in the 80s. The rates were at late 70s, early 80s, rates were at 20%. But we chatted on this before the start of the show. And my argument was the medium income compared to the medium home price, the ratio, the difference, the relativeness was much less than it is now. It's much greater. So maybe briefly touch on that.
I think, again, it's a supply and demand as well as government regulation. So like in California, they're always screaming about affordable housing, but like where I live in Marin County, it's a kind of an affluent area. They put all these restrictions on you. Have you heard the term NIMBY? Not in my backyard. Okay, and if you're familiar with what Governor Ron DeSantis did in Florida, sending everybody all these people to Martha's Vineyard, right? And they were like, they got these signs that, oh, we love immigrants, we love this. Oh, wait a minute, you're here? No, we don't love you. 44 hours later, boom, they were out. Okay, so the government, even the state government, will say, oh yes, we want you to do all this affordable housing, but oh, by the way, you're gonna have to pay all these permits. You're gonna have to do all these regulation requirements to make sure you're not imposing on the spotted owl and the watersheds and blah blah blah. And it gets to a point where developers and home builders look and they say, we can't afford it. well, I mean, we can't make enough of a profit. Lumber prices have gone way up, and labor's gone way up. And so it's a supply and demand where you get more people, people are living longer, population's increasing, but the housing is not uh, exploded enough. Also in California, a few years ago, we had some pretty major fires. We lost 5,500 homes, which is a fair amount in one area. And so what does that do? Well, people, they're not going to live in a tent generally, unless they're homeless or something, right?
Yes.
So yeah, you
Well,
have
there's a lot of homeless in California. There's 100,000 homeless, but let's switch. We're gonna be switching the conversation to the investment side and private equity side. But a couple other questions for you right before we go there. Let's talk about your guys' mandate as an investment group, right? You're raising equity from your passive investors, you put it into your fund, and then you allocate that capital to individual borrowers. And your strategy is you don't go above 75 LTV. You assess who the borrower is. All those vetting process that you do very astutely. Now, how in an increasing interest rate environment that we are currently, where the markets are changing constantly, what happens with your mandate? Are you and your team getting together in the office and saying, hey, our mandate is changing? Does it stay the same? Like, talk to us about the kind of behind the veil, what happens in the mastermind kind of situation?
I get what you're saying. Okay, so again, it's a supply and demand situation of money. So in California, there's still a fair amount of money chasing deals, and it gets to a point where we cannot raise our interest rate to a new borrower above a certain threshold, because he can go down the street if there's another hard money lender who will lend it to him at a cheaper rate. That's why, again, you go to Ohio and your borrowing rates are going to be higher than they are in California, because there aren't as many lenders in Ohio. Okay, so if you're a borrower, but obviously if you're a borrower in Ohio, you're not going to come to California because they're not going to lend to you, right? So,
but how do you do that research? How do you get the market research of where the market is at? Do you have other groups that you guys work with? Do you have certain software that you use? How do you know tomorrow where that number is going to be? Where is going to be your spread?
Mostly it's going to be driven by the brokers. I believe it's driven by the brokers, because it's rare that someone comes. We actually occupy an old bank building right on a main street, but it's rare that someone walks in our door like they would Wells Fargo Bank and says, "Hi, I'd like to get a loan from you guys." And because usually the first question we ask them is, "Why are you coming to us instead of Wells Fargo? Our rates are a lot higher," right? So most of our business is going to come from referrals from other banks, mortgage brokers, realtors, those kind of people, rather than the general public walking in. So the mortgage brokers are going to be also on top of things, where they're going to say, listen, my borrower, his threshold is, let's say someone, because we've had this before, someone has $1 million in the bank, but they just, for whatever reason, like having that money in the bank, they don't want to touch it, and they only want to borrow $800,000. Now, they're obviously earning a lot less on their $1 million that's sitting in their money market account, but it makes them feel good in case there's some emergency, they have to rehab the property, et cetera, and they want to borrow $800,000. Well, if you push them too high a limit on the rate, at some point they're going to say, forget it. I don't need your money. I will just cash in my money market account. So it's a supply and demand situation of that. And as interest rates go up, eventually you have to raise your rates, because your investors are also banging on the door saying, hey, interest rates have gone way up. Why are you, in this fund that we were talking about, our Freedom Fund, it wasn't too long ago that we were paying a flat 6%, no matter how much money you had in there. Well, eventually people say, well, 6% is good, but, I think there's other companies out there that might give me a little bit of a higher rate. Now, they may be riskier, but, so it's all, there's nothing set in stone, because we've had brokers come to us and say, listen, I just can't push my borrower to that rate.
Got it.
If you can do it for a little bit less. And sometimes what will happen is we'll say, well, if they can put down a little bit more of a down payment to make instead of a 70% loan to value, if they come in and make it a 60% loan to value, it's almost like buying down the rate.
Yes. Now, you've been in business for a long time. Have you ever been involved on the equity lending side? Like a pref equity position on the stack?
Yes, and we do well. Some of our debt funds have an equity piece to it from the standpoint of there are some profits in there. Some even on our debt, like as an example, on the construction loan fund, there's a preferred return, but you get a percentage of the profits. So that's a percentage of the profits of the fund, but the fund may have a borrower who they've partnered with to be able to do part loan and part equity in a project.
Part debt, part equity. Perfect. Okay, awesome. Now let's switch the conversation here quickly to investor relations. Ava is head of our investor relations and is also my boss. But let's talk about that. We talked about investor memos, investor presentations, pitch decks. We talk about communicating with investors. So Ava, go ahead. If
Brian, I'm sorry. Edward. I was gonna say I really wanted to get your opinion on this and like what makes the perfect investor presentation, because you always get two sides. You're like, it's too much info, not enough info, it's too long, it's too short. Talk to us about.
I think less is more. If you inundate people with too much, they get confused. They just do nothing. Also if there's too many choices, we have 45 different funds and blah blah blah. It's like that's crazy. Now prior to COVID, we had marketing to various people who were interested in what we had to say, and we would have like a little wine and cheese party type thing, and we'd do our little presentation, and a lot of it was just storytelling. And then we would have a picture of the, like, as an example, here's a house, and we would explain why this borrower came to us for a loan and what we charge them, et cetera. And so, again, you can't have no slides at all, because then it's a little hard for people, most people at least want to have something tangible to see.
Yeah, absolutely. I love that you said storytelling, because that helps people relate to it and understand things better and so forth. Now you've been with the company since 2013, and ever since you started, you were investor relations. So
Yeah.
Okay. So I was going to ask you. So how do you source investors? How do you guys source investors at your company?
You mean how do we get investors?
Yeah. So for example, with us at CPI Capital, this is our top of our funnel. We have our YouTube show podcast that you are currently on. So people watch it, they connect with us. We are very active on LinkedIn. We speak at many other stages. We speak on other people's YouTube shows and podcasts. We rent booths at a lot of conferences.
We do a lot of content on social media.
We do a lot of content consistently. So these are all up here. So people connect, and then they connect with us. And then we go from there. With you guys, obviously, because you're more on you're somewhat institutional. Do you use the services of broker dealers, or do you have these strategies that you utilize? Like, where are you guys at when you connect with investors?
Yeah. So I've again, I used to be in the investment community. I used to have my Series 7 securities license, all that. So I can speak one-on-one with a lot of investment advisors, and they understand me and I understand them. And I also, because my background in accounting and tax, I can speak to CPAs and we can talk the same language. So trying to get into that market, we'll be at various events where we're promoting our funds, and most of the time it'll be for investors versus the loans themselves, because the loans will come from the various brokers. We just have to get out in the community. And we have, email lists that we've compiled. I've written articles, throw them on to various publications and LinkedIn, I guess, once in a while. See, it's so funny because I'm not the best marketing person. I'm a very good salesman, but I'm not a great marketing. Like my little pitch here is, you put me in front of 100 people, I'll sell 99 of them on our product. My thing is, how do you get 100 people in the room, And so I need to work with the marketing people to do that, and then I do the sales part, and then I'll follow up with clients who have questions, because I know the actual prospectus fairly, I know it somewhat inside and out. So I
Yeah,
can
no,
pretty much
no.
answer any questions that come up on that.
Talking about that, I mean, just by talking to you in the last few minutes, you come across very knowledgeable, come across very trustworthy, and I'm looking to forward to invest in. I've been thinking about for a long time to invest in, debt funds. So I'll be in touch personally. I've always promoted to investors and colleagues and my friends to always have an allocation to debt funds. So that's my view on it. But you had a question?
Yeah, no, I was just going off of what you just said, you kind of mentioned that you wrote articles. So I was gonna say, talk to us about the systems and processes that you have in place for communications with investors. Do you guys take that educational approach, or, is it?
So our president writes a newsletter. He used to do it once a month, but he got so busy that he's been writing it like once a quarter to kind of let people, a little bit of education, and then also let them know how the fund's doing. People do get their monthly checks, and then they get statements with it, because you could either take a monthly check or reinvest for a compounded yield, adds another roughly 35 basis points. So there's that kind of communication. And then I guess on LinkedIn, every once in a while, there'll be some blog posts and that sort of thing. I'm an old guy, so I'm used to 2 tin cans and a string from communication.
Yeah, there you go.
Can you raise from Canadians?
Oh yeah, we can take money from anybody as long as they're accredited investors. Yeah.
Nice.
And Edward, I always like asking other investor relations about this question. How are you with the current environment that we're in right now? How are investors, speaking to you? Are a lot of investors still sitting on the sidelines saying, you know what, Edward, now's not the right time, I'm going to sit on the sideline? Like, what percentage would you give it that investors are investing? And
that's I love that question. Because generally, we don't even look at them as investors. They're lenders, right? Because
passive lenders. Passive
lenders. Exactly. So, in fact, that's one of the things when people say, I'm thinking about sitting on the sidelines. If you've got the money, why don't you sit in the sidelines by parking it in our Freedom Fund, getting 7%, and then just give us notice when you find something better? That's fine. We got no problem with that. The question that I have gotten once in a while is, with the market being, changing a bit, interest rates going up, there have been a lot of, cancellations you've heard about from people who wanted to buy houses. They canceled their contract because, the bank raised the interest rate, and now they're not going through with it. The interesting thing is that even though the market has slowed down a bit, we've become kind of a bigger fish in a smaller pond. The reason I say that is that a lot of mortgage companies, when interest rates have gone up the way they have, the refi market has dried up considerably, right? It's really only those purchases that are the real need for money. So there are a lot of big mortgage companies, banks, et cetera, who have laid off a lot of people because they're just not seeing the demand. Well, what happens when you have a smaller pocket of potential lenders, right? We're still out there lending, so we've become larger. Now, obviously, we're not as large as Wells Fargo, whatever, but we're one of the larger alternative financing companies, and we're still extremely busy. So we're getting a lot of loan requests that maybe we wouldn't have gotten, but for the fact that you call, and I'm just picking Wells Fargo because everybody knows the name. I love the bank. I've got no problem with them. But, you call Wells Fargo and they say, hey, this is great, but, because we've laid off people and, title companies are busy, et cetera, we can do your loan, but it might take 45 days. Well, what if someone has the opportunity to buy a property? They have to close in 2.5 weeks. What are they going to do? They'll come to us, get the loan, and then they'll refinance with Wells Fargo or whoever, because we don't generally have, on owner-occupied consumer bridge loans, there is no prepayment penalty. So they can pay us up. We did a loan one time, we got paid back in a week.
And there's no
because 1 week, yeah. And the reason is because they were supposed to get a regular bank loan, but their timing of when they're supposed to close, it was getting shorter and shorter, and they didn't want to lose their deposit in their dream home. So they came to us, got the loan, and then sure enough, the bank came through. Well, a week later. So, yeah.
Any questions, Ava, before we move to the next segment of our show?
That was fantastic.
I have one more question.
Of course you do.
Sure.
You talked about expert witness. When you talk about expert witness, you're talking about court of law, I'm assuming. And when you talk about court of law, the question comes in is, possible expert witness in a case of someone doing something unscrupulously. Talk to us about what expert witness, and then I can ask you some more questions, because it's very interesting. In the finance world, there's obviously a lot of concerns about fraud and money, investors' money not being used the right way. Is that the type of witness?
There's been a couple of different, because of my background, accounting, tax, investments, real estate. I've been hired on a few situations. One of them was, and again, I'm bringing this out. I am not anti-gun. Okay, so this was, so forget that issue. But I was hired as an expert consultant. I was supposed to be the witness, but the opposing counsel didn't have time to depose me, so they accepted my spreadsheets but wouldn't put me on the witness stand. But it was the largest case in history against a gun manufacturer for a gun defect. It was a $50 million judgment, and I was brought in because toward the end, after the judgment that the attorney got, the defendant tried to hide all this money and go bankrupt, et cetera, et cetera. And so my job was to do kind of like a forensic accounting and into the accounting, the financial statements and tax returns to figure out where did the money go, et cetera, et cetera. So the spreadsheets that we worked on together got published in, the judge accepted our spreadsheets. They got published in the bankruptcy court and affirmed the judgment. So it was kind of nice to be, hired in that case. It's just that it was an unscrupulous defendant, and that's just,
Got it.
But I've also had investment situations where I helped on the defense side, where somebody was suing the securities broker for something that I didn't think that they should have. And then most recently, there was a real estate syndication where there was a loss, or there's an anticipated loss, and the defendant is suing, excuse me, the plaintiff is suing the defendant, and I'm being hired by the defendant to analyze what the lending deal was and to determine whether or not it was reasonable. So that's how I've been hired.
Where's the deal? We might go and buy it.
It's out of California.
I'm just joking around.
It's in the Northeast.
All right. Great. Let's move on. Thank you for that. Really appreciate all your knowledge and wisdom. Really helped out a lot. Let's get to the more fun part of the show. If you haven't had enough fun, this is going to be lots of fun. Let's do it.
All right, here we go, August and Edward, the 10 championship rounds to financial freedom. So I'm going to ask questions, whatever comes top of mind. Here we go. First question. Who was the most influential person in your life?
I'd say my father. He was an accountant and got me interested in finance and investments when I was about 11.
The apple did not fall.
No, that's true.
Like your case, Ava, where your parents are extremely conservative and you're an entrepreneur. So
there you go. Love it.
Both of your parents are accountants. All
That's
right.
right.
Great.
That's right. Alrighty. Next question. What is the number one book you'd recommend?
Absolutely has to be the Bible. And I don't mean just because generically, the Bible. It's amazing how much wisdom is in there, specifically in Proverbs and Psalms, that is life affirming and gives excellent advice. Besides having Savior of Christ, which is obviously the biggest thing in the world, but let's say if you just forget the spiritual side of it and just look at the absolute words that are in it, it's not a book that you say, well, that's a few thousand years ago and it has no relevance. It absolutely has relevance. Like don't keep company with bad, bad people corrupt good people. Stuff like that. And so you look at stuff like that and you go, yeah, you know what, that's really smart. So it's kind of a living, breathing document.
Absolutely. And but we get to answer a lot. It's usually the purple Bible though, not the regular Bible,
which is Rich Dad Poor Dad.
You know what, my wife actually got turned on to that book.
Oh, did she?
Yeah, because she does not have a financial background, but somehow she got turned on to that book, and it's been very good for her.
Yeah, just tell her not to follow the author on Twitter. She will burn the book after that. But
We'll have to read the cash flow quadrant after by Robert Kiyosaki when she's done that one.
Okay, a cash flow quadrant. You have to send me that. I'll have to write that
Yes,
one down.
100%. I'll email you. All right, next
Yeah.
question. Edward, if
Yes.
you had the opportunity to travel back in time, what advice would you give your younger self?
I was gonna say be more conservative. Probably look at what potentially could go wrong. Because I think in my younger days, I mean, it's funny. In 1980, I made a mini killing in the stock market, and you think you know everything. You're 20 years old. You know, you do something fantastic that even the adults say, "Oh my gosh, I can't believe that you did that." You know, and then you end up making mistakes on that. So, and keep the ego out.
Yeah,
Nobody makes money on ego. You know.
stay off the high horse. Yeah.
Yes.
All right. What's the best investment you've ever made, other than that one in your 20s?
Uh, oh, absolutely. This. So I had a friendly foreclosure on a building in the Silicon Valley prior to the internet. So again, blending. You know, you say, "Oh gosh, I wish I would have owned that building." Well, guess what? I own that building. So I foreclosed in 1994. Uh, and it's gone up considerably. It's funny because it went way up, then it went way down, then went way up, then it went way down, and now it's kind of back to going up again.
Roller coaster of emotion.
That brings a quick question here. Now, on the deals that you talked about, you guys have 1 to 2% default rate. When a deal does default, do you guys go and take it over as owners and then go and, because private lender individuals, if a project defaults, they literally now own it and they have to either sell it or continue to value add.
Which is why I tell people I would not do individual lending unless you're going to own 100% of the loan, or you're going to own more than 50% and intimately know every single person you're in with. Because I've had some bad experiences where if you do an individual loan and something goes wrong, now it's like trying to herd cats and have people put in money and make decisions on stuff. You don't want that. Versus a fund, if something goes wrong, the fund manager decides what to do, and generally speaking, we'll make money because we're not lending at 110% loan to value.
Absolutely. I'm allergic to cats, so definitely.
There you go.
Okay.
Next question. What's the worst investment you've ever made, and what lessons did you learn from it?
Land deals. Unfortunately, in 2005, excuse me, 6, 7, and 8, we did not foresee the value of land dropping, even in California, but it happened. And unfortunately, that I would say that was the worst.
The big private equity firm here in Canada went belly up. They were land buyers. It was huge. It was big. It was a big flop.
I mean, my old company is still in existence because some of those land deals are still out there, but we haven't gone belly up. It's sort of, I'd say, kind of a dormant type company.
Okay.
So that to me would be the worst.
Okay, Edward, next question. How much would you need in the bank to retire today? What's your number?
He's got a building in Silicon Valley. He doesn't even.
Yeah. Well, I always tease people. I said, forget millions and billions. I want to be the world's first trillionaire. But realistically, gosh, you know what? With the way inflation is, and it all depends on your standard of living, right? I mean, make as much money as you can and spend as little as you can, and and give obviously to charity. So, is there a magic number? I don't know. It depends on your lifestyle. No, not trying to be evasive, but
Yes.
having let's say $1 million in the bank, unless you're only going to live 3 years. I mean, that'll cover you, right? Because that's the other thing, is you don't know what your longevity is.
Yeah.
Is that an okay answer?
Great answer.
Yeah.
Great answer.
All right. If you could have dinner with someone dead or alive, who would it be?
I'd rather have someone who's alive. But no, I know what you mean. I'm just kidding you. Wow. Besides the obvious of Jesus, that's a great question. I think just off the top of my head, somebody like Ben Franklin or George Washington, one of the original founders, to just kind of see
We get that a
how,
lot. We get that a lot. But yeah,
yeah, but I mean, not just the general, first president, blah, 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 but there's so much that a lot of people don't know about. And I actually learned a lot, believe it or not, in church about the founding fathers and how their relationship was with Christ and just how they foresaw. It was amazing. I mean, just when you look at our Declaration of Independence, how there's so much in there that you'd say, well, no, this was probably written yesterday. How could these guys foresee these issues? And how he said, I don't know. They want me to be king. Forget it. That's what we exited Britain for.
they should have just clarified the bare arms, what they meant by arms. They should have just clarified that a little bit more. It would have caused a little bit less troubles these days.
Well, it's funny. Someone, I think it was Biden who says, well, you weren't allowed to own a cannon. Actually, you were allowed to own a cannon. And then that's the thing is, like, say, I'm not an anti-gun person, whatever, but I used to be. My attitude used to be only the police should have guns. That would make it really simple. But then someone pointed out to me, well, the first thing guys like Hitler and Mussolini do is and Stalin, you take the guns away.
Or the mullahs in Iran.
Oh yeah.
That's
look
the first thing they did in revolution time. There's no gun ownership in Iran, and
it's really to keep the government from fascism and all that. So, and the thing is also, and I know we're kind of getting off topic, but just if you think about it, if you suddenly say there's no guns allowed anywhere, well, do you think the bad guys are going to say, okay, well, I'll turn in my gun? No, the first thing they do is they go, awesome, nobody has gun but me. Now they're going to be a lot more brazen.
Right.
Go ahead.
Yeah. Right. Okay. Next question. If you weren't doing what you're doing today, what would you be doing now?
Well, okay. So I used to be a semi-professional bowler. I was not quite good enough to be like the guys on TV, which made me kind of look and go, you know what? I think I got to finish off college and do another.
You actually kind of look like a professional bowler, man.
Oh, thank you. I don't know if that's good or bad, but I mean, would I love to play professional baseball? Yeah. Was I good enough? No. So you mean just like in business, what would I be doing, or just anything?
No, a professional bowler.
Yeah, perfect. Absolutely. That was probably a perfect answer, man.
That's awesome. We've never had that before.
All right, there you go.
Love it.
It was a strike.
Right. Yes.
Yes. Okay. This is a good one. Book smarts or street smarts?
Street smart.
Street smart.
Okay. Yeah. I mean, I'd like to say I have both because I've got the, knowledge to get a graduate degree, et cetera, et cetera. But there's so many people who have no common sense. It just drives me crazy. Quick little story. When my dad was alive and he had his own accounting practice, he wanted to hire an intern. And so he thought, well, UC Berkeley. I mean, that's, one of the most prestigious schools around. Yeah. So he asked them to send somebody who was studying accounting and, a senior almost ready to graduate, right? And this person comes and they were taught, for whatever reason, they were taught all this ethereal stuff. They didn't know how to balance a checkbook. Mm-hmm. And it's like, really? I mean, come on, you gotta, come on, let's use, well, again, no offense to that person because maybe they just were never taught. So there's just more ignorance or naivete, but definitely to me, street smart. And it's funny because here you got somebody who's got a graduate degree and you think, oh, the person's going to be book smart, like that's the most important thing. Absolutely not. Street smart's much better.
All the way. Okay, right on.
Probably, I would say 99% of our guests have answered street smarts, but keep going.
Okay, this is the last question, Edward.
All
okay. Right. If you had $1 million cash and you had to make one investment today, what would it be?
Boy, obviously I'm a little biased, because again, everything's based on alternatives, right? I wouldn't put it in the stock market. And it's funny because I used to do really well in the stock market, but it's such a game nowadays, it's manipulated. I wouldn't do that. Would I own a piece of real estate? I don't know. It comes with a lot of headaches. So I like the lending space and I would be a lender of it. Now, whether I invest in, this fund or that fund, et cetera, but I pretty much do exactly what I'm doing.
Right on.
Tremendous.
Right on.
Tremendous.
Now, can you just say out loud, Edward, what's the best way for people to get a hold of you, please?
Okay, so first of all, if they want to get a hold of me personally, it's Edward Brown. My email is edward@pacificprivatemoney.com. You can also go to investor.relations@pacificprivatemoney.com. That's probably the best way to get a hold of me.
Right on.
And just to close this off, I got to say, if or when or maybe when we start a debt fund, I am going to poach Edward Brown.
Oh,
and that's going to be
It's so funny. I got to tell you, our president, Mark, is such a nice guy. There are so many times when he's just done things where I have to almost rein him in. Mark, why are you giving away all our secrets? I mean, and he's just like, you know what? The way I look at it is you just give, and eventually comes back to you. And he's right. So I've learned from that. And so I was like, you call me, I'll be glad to help out.
Edward Brown, thank you so much for taking the time being with us here today.
August.
I appreciate all your wisdom, again, all your knowledge. I wish well for you guys and your team. I might be a future client, so have a wonderful day.
Thank you.
And believe it or not, I actually get that a lot from people who interview me. They say, you know what? That actually sounds pretty good. I think I'll check that out. So you go to pacificprivatemoney.com. You can see all our funds there.
Actually, this was a plan for Edward to actually come and solicit us, unknowing
Yes, that's right.
close us. This is how he's going to close us. So
There you go.
Excellent.
Thanks, Edward. Have a wonderful day, everyone.
Thank you very much. Pleasure.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.